Investors are truly having a blast. As short traders review the year, they're simply aghast. And peddlers of doom, now completely outcast. For me, I'm haunted by ghosts of tough years in the past. Even bulls are asking me, can this thing last? So I asked Steve Miller, can a 9-year bull hold fast? So I searched the old videos and found this historic broadcast.
Well, I'm going to the city and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in the next week. And hopefully, lots of great ideas and opportunities for you throughout the show. Well, the stock market gained strongly again this week, overcoming a pretty good selling squall that came on Thursday. Friday, optimism came back into the markets as the tax bill seemed like it was very, very close, and some of those senators that were looking like, well, they may not be a yes vote, well, they started to, I think, fall back in line, getting what they're asking for. Overall, it was a choppy week as focus moved from the Alabama Senate race to the FOMC to the tax bill. And now here we are on Friday, and the market is rocketing to the upside. Typically, end of the years have some thrashing in there, as there's a lot of money that moves from one sector to another, and people make all kinds of switching based on tax consideration. Gotta wonder this year, investors, seemingly very happy to hold on to gainers, and looking at the potential for lower tax rates coming in the next year. Well, for now, they seem to be holding on, but end of year tends to bring some surprises. I've seen many years where you get into the last couple weeks of the year or into the first week of the next year, and all of a sudden we end up with a lot of volatility. So for now, they're happy holding on, but we'll see if that's the case in these next few weeks. Let's take a look at our 60-minute chart of the S&P 500, where we look at the gray area being the overnight trading and the white area being the area of trading during the session. And man, your eye has to go all the way to this side over here where the market is just exploding to the upside. Monday saw that pipe bomb explode in New York City, the Port Authority, and that bus terminal. The market before the opening took a hit, but then Apple moves up over $3. It acquires Shazam. And that drove the NASDAQ to the upside Monday. Tuesday overnight was quiet, but then we got a rally in here as the markets were waiting for the Alabama results and the FOMC meeting on Wednesday. You see we had a weak close over here on Tuesday. Here was the news in here that Jones won. Moore, he didn't want to concede that and still hasn't. And then overnight the market started to recover. And news came out about inflation. Core inflation was soft, even though the headline was up 0.4%. Bonds had a rally, and of course the dollar dipped when bonds rallied. So now the news comes out that they have a tax plan deal, and then it was kind of sell the news. You see this? And then the FOMC FOMC came out, and they raised a quarter point, which was in line, talked about growth being stronger but inflation being lower, and overall this was another dovish meeting. Surprisingly, you had a soft close. You see that big decline right over there. On Thursday, retail sales came out stronger. Before the opening, you had a little blip, but here the Russell really started to get weak. It was as if they were rethinking that tax plan, and are we really going to, is this tax plan really going to benefit the smaller cap stocks? So you got this huge sell-off that came in here on Thursday, but then Friday they started anticipating the tax bill being unveiled, and then they were playing with the numbers and increased the child tax credit. The rumor was Marco Rubio was now a yes vote, and that brought the market up. And the stock market is soaring here on Friday with the S&P 500, as I do this with just about 2 hours to go in the day, up now a very close to 1%. The future's now up about 24 points on the upside on this very strong day that you can see in there. So that is a look at the 60-minute chart of the S&P 500. For the week, so far, the stock market has been strong. Its indexes really have been all over the place. Most of them up between 1 and 1.75%, and the RUT, though, a laggard, up about 0.5% now on the week. So that has continued to be a laggard, and all of our shorter-term indicators show that as the weakest index of all. Bond market, 30-year up 1 point, 10-year pretty flat. So as you see, as the 30-year goes up and the 10-year is flat, that is a further flattening of the yield curve. There's a lot of talk about the yield curve right now and flattening, and that at some point next year it will invert. And of course, all of the bulls are saying, well, that doesn't matter because it's different this time. Well, we'll see if that's the case. I actually don't think it's going to invert next year. The dollar is basically unchanged on the week, recovering from big dip on Wednesday, getting a rally on Thursday and Friday. Gold and silver, gold finally gets a bounce. Gold up about $7. It's not anything huge. And silver up about 20 cents on the week, and oil about unchanged on the week. So basically the real action here, of course, in the stock market this week. So I want to take a peek at a chart that I don't often look at, and here on Market Week, I usually stick to the shorter term charts on the stock market, but I just want to take a peek at what we've looked at here this last year, these last couple years in the stock market. I'm going to show you my weekly cycle chart. It has cycle analysis on there, and you're going to see the outstanding moves and the outstanding recurring patterns in here that have driven this market up. Here is 2016 and 2017 in the weekly S&P 500. So you can see in here that there is clearly an uptrend, right? Well, how strong is that uptrend? For the 2-year period, it's up a total of 47%, coming from just over 1,800 in the S&P 500 over here on the low, up to this level up here of 2678. So this monstrous move. What's really interesting about these years, I mean, these are 2 years back to back like we have almost never seen with this kind of gain. Now, for 2017, which is the 9th year of the bull market, 2016 the 8th, we have had barely a dip. You had a tiny little dip right over here in the middle. I want you to note the cyclical patterns, and that is, this is the ideal cycle pattern right in here. Now, if you put the channel over the ideal, then you get the upward trend, and you can see the perfect upward movement in here as these cycles just lay out almost perfectly. Each of those lows in there about 19 or 20 weeks apart. We are now 17 weeks into that rally, and there you could see those beautiful cycles that you have in there. That calls for a decline over the next 2-3 weeks. You can see that right there as it's projected. And this is just one amazing year that we have looked at in here. I mean, we rarely get cases of barely no declines whatsoever. This is the nightmare for the short side traders or for cyclic analysts like me who look for corrective periods to bring deeper declines. You can see right in here, well, this one brought 306 points in that decline in the S&P 500. This one over here brought 129 points. This brought 110 points. And then it got, less volatile and less volatile. The only correction in this entire year of any consequence were these two, and one was 78 points on the S&P 500 and one was 70 points. So incredible situation in here where we've had this massive upside move in the market with almost no volatility, and you could see 5 very clear cycle patterns in there over these last 2 years, year 8 and year 9 of this incredible upside move in this market. So, it's been, this a year that we're in now, it's been about 22 years since we've seen a year anything like this, back to about 1995. With no corrective phases that are 3%. It's fantastic, and it certainly makes the analysis tough. Tony in Mexico, a friend of mine, shared a chart with me that was really interesting that showed the volatility spikes during the year. In other words, the few times that the market actually was tradable, and there was only really 4 days in there that the market had any significant volatility spikes in this entire year. So thanks, Tony, for sharing that with me. Really a year that wasn't for traders, purely for investors. And if you're a momentum trader and you believe the bull market, because momentum has barely flinched from its upward trend all year long, then you've done fine. And good for you for being great traders or great investors. I think 2018 is going to be much more volatile. 3 years in a row like this, forget about it. I don't think it can happen at all. I think we're going to get a lot more volatility coming into the next week. And that actually could be starting before you know it, and might even be in the next week. Speaking of the next week, it's a vacation week for me. I do that once a quarter, so there will be no market week show on the coming Friday. That's December 22nd. And for my members, December 28th will be my big picture analysis of the stock market, where we take a big look at what is likely coming for the stock market in the coming year. And then on the 29th is my year-end show, where I take a recap of everything I said is a year before about what I thought the best and riskiest stocks would be for 2017, and then look forward at 2018 and see what I think will be best for them. Don't forget, follow me on Twitter, also on YouTube. Become a member there, and make sure you put a thumbs up on this video. Always like to have that. And you want our specials on all of our content, just write me slim at askSlim.com, and I will send you our half-price 1-month specials. That's it for the opening segment, and I'll be right back to you with the best of the week. All right, this is the best of the week. This is where we look at charts from the stocks that have had, exceptionally good weeks. We're going to open this one up with Teva. Now, Teva is a stock that I have liked. I've liked it a lot. And I've liked it because of, I showed you those cycle patterns on the weekly S&P chart. Well, there's cycle patterns on most of what I look at. In fact, I look at over 300 stocks, and about more than 75% of them have very readable cyclic rhythms in them. So you'll see that in here as we look at Teva. Now, Teva has been in a massive bear market. They're in the generic drug business with massive competition in there, and the stock has fallen apart, coming down in the last couple years from 66 all the way down to $10. Now, I believed it was going to rally, and you got a nice 5-week rally that you could see right in there from 10 to 18. That is an 80% advance. I'm sorry, it's 11 to 18. So we'll call it a 70% or so advance on the upside. Now you could see it's been following this 34-week to the downside. That's 34-week moving average, and now coming up to this resistance zone. We've been positive on it. We thought it was going to have an upside pop. If you look at, historically over these last couple of years, you could see this was a 5-week rally right there in that cycle. So we're looking at the rising phases in the cycles right in here. This was practically non-existent. We call that a left-hand translation. About a 3 or 4 week rally right there. And here we are now 5 weeks into the rally, coming up to the resistance zone. Why did they rally this week? Well, it's because they're cutting their workforce by 25%. They're simply trying to survive. If you ask me about this stock, and I know a lot of people that follow my analysis have been long it, I think, well, like Steve Miller says, take the money and run, because I think it's getting up to a very, very tough spot for it. When they're cutting 25% of their workforce, they're getting the bare bones. There was other stocks that I saw that happening in, like Chesapeake Oil, when they were selling off stuff and getting down the bare bones, and the stock just collapsed. So here you got the stock moving up to 18.5-ish. I wouldn't be surprised to see it down at $10 again sometime in the next several months. So I think it's time. Let's take a look now at United Airlines, at Under Armour. That one always gets me. UAA. This stock also getting a decent upside week. This stock was on my list of the riskiest for 2017. And you could see that was pretty great call when you look at that, as the stock moves from, for the year down around the area of about $29 and goes all the way down to $11. So I've had some really bad calls this year too, but I think more good ones than bad ones. Now you can see the same thing, just like we showed you in Teva. We're in this period of the investors starting to chase the dogs. And I'm going to put this in that category. Yeah, it can get up into this resistance zone over $15, but I don't think it's got a lot left in it either. So we would look for Under Armour to have a tough time. Speaking of buying the dogs, Triple D, Under Armour up 12% on the week, Triple D up about 8% on the week. And you can see the buying coming in here. This is very out of place where that upside rally is. What does out of place mean? Well, it means that this is a declining phase that goes into January. This is a rally that lives inside of that declining phase. And that says to me that it's likely to fail. And this points to about, 3-4 more weeks on the downside. I don't know what they're celebrating. Hewlett-Packard's going to be killing these guys pretty soon, because they're going deep into 3D printing. So not exactly anything to be all that excited about when you look at Triple D. Strong on the week, but still, I don't like it. This is a really interesting one that had a big gain this week, and that is Freeport. Look at this massive move. Now, there are lots of cycles on the bottom. What we're tracking on the bottom in here are, the DBB is that dashed line right over there. Copper is this line right over here. So we're tracking all different things, and this is gold right over here, because Freeport is a gold and copper stock. And this one is just completely fighting the soft metals. There's something about this that is just great. We were getting failure warnings over here, and what looked like a breakdown that actually survived and then had this big explosion, as you could see. We're calling for this to have a few weeks on the downside. Now note that support zone right around, 1560 or so. I think if it pulls back into that zone, it's going to be a very good buy. It's a great looking stock, up 11% for the week this week. Now, Tesla is one we have not liked. Tesla had a good week, up about 8% on the week, And that stock, to us, is at a problem area. So it's starting actually to back off of there a little bit. Now, if we just look here at these last cycle patterns in here, what we were looking at was that we believe that this stock has had a pretty significant breakdown. Now, if it gets above this level right over here, which is about 365, that's going to change the picture in there. So for the moment, we have to stick to what looks like a bearish scenario, and that is failing at this resistance zone and then coming down through this time period right over here. The triangle actually got an upside breakout, which is only about a 1 in 3 probability. It's usually 2 and 3 that you get one that follows the original trend, which would have been breaking down. But you got that upside movement into this resistance zone. Up 8% on the week. Analysts see the Model 3 bottleneck going away, and essentially the bear food that the shorts have been living on may disappear. Well, that might be the case, but they have a massive burn rate, and their cash flow situation, which analysts are talking about, getting a lot better. It's going to take some unbelievable deliveries and sales to really get that situation to change. So we think that Tesla really still is in trouble. We're watching 365. We want to be short it, but at 365 the play is over. So we always want to look at both sides of that, and right now we think Tesla is still bearish. That's the best of the week, and now coming is the worst stocks for the week. All right, for the worst stocks for the week, well, the worst group basically were the drillers. Oil was, flat on the week. It softened over these last couple of weeks after trying to get up through $59. And natural gas is really in horrible patterns and looking very bearish. So I think that the drillers may be suffering some pullback from some of the rallies that they've had. We're going to take a look at these. Neighbor, Noble Corp, both up about 10%. Rig, RIG, up about 4, down about 4. I'm sorry. They're both down about 10%, and Rig is down about 4% on the week. Take a look at this NBR pattern, and you could see, well, it really doesn't look very good when you look at this, and this is the picture of the drillers basically that have had a very rough time of it. Now you can see that our projection has about maybe 3 or 4 more weeks of this decline. Let's just take a closer look for you to see. And this is our target for the low about the first week of January, and then we think it's going to turn up. So that stock could be better when you look at that timing, but it's still a negative pattern, a negative cycle, negative momentum in there on all time frames. Now when you look at Noble Corp, this is a little bit different situation. Now let's just get a little closer look for you to see, and that is that it is building a base. Now, what is a base? A base is after you have a big decline, it makes a bottom. It rallies and then corrects and does not take out that low. So this period right in here is a basing cycle, as we call it. Just like we said in Neighbor, it has approximately 3-4 weeks to go. First week of January is when that low is likely to come. And based on this formation, the probability of getting over this level is very high. So that's about 470, 475. And it's now trading at about 378. So we think you're going to be able to buy this somewhere around 360 or so, and ride it up a point. That would be like a 30% gain. I think that is a good possibility. Now, if you look at RIG, RIG, this stock down 4% on the week. This is a monstrous pattern. This is the kind of pattern that I start to call a stock potentially having the prospect for being one of the best of the year. If I believed oil was going to have a big upside move, then this pattern right in here is massively bullish. Note it has about 3 weeks to go in this declining phase, and then moving up again. I don't know if the energies are going to be able to be that good next year. But overall, this one has a high probability of trading, up to this $12 area. So I think you can easily get a 25% gain in here in this next move. I think RIG is a very, very solid one in the group. CSX CEO went into medical leave, and the stock had a break, and you could see that right in there. Interesting, it happened right at the top of that channel. You can see this weekly evening star that formed in there. It did that right over here to peak that cycle. Do you see the cycles in here? You could see in here the rally and then the sell-off, the rally and the sell-off, the rally and the sell-off, the rally and the sell-off. Look at the perfect timing on that. Again, this is about the first week of January. Isn't that pretty amazing how these things are lining up? So there's some kind of, decline probably out there, and you can see how these cycles lined up right in here. It's just perfect cyclic action. This decline was due, and there it comes, and probably gets down near that bottom of that upward channel that was in there, probably near $50. But then after that, probably going to get a rally again, as you can see our projection in there. So, of course, CSX, a railroad, down on the week, modestly and timely based on our work. So the retail sector is having a pullback. Talk about the dogs. Well, those things got bid up pretty significantly as retail sales got stronger and better than expected in the Christmas season. We're going to take a look at a few of these. A&F down about 5% on the week, and it had a pretty sizable upside move. And you're going to see something that is what we call cyclic synchronicity. And that is when these patterns time out to all bottom at the same time period. You can see right in here, different group than I just showed you, but A&F points to a bottom in the beginning of January, which means this decline, and this, by the way, is an evening star forming, goes down for the next several weeks. It should get under $15 in there on this correction. So we're going to continue to look for the pullback in A&F for the next several weeks. DKS down about 5% also. There's an ugly resistance zone you can see screaming right there, and it starts to get a pullback. This has been a pretty bad stock, and they better have one massive Christmas season, or this stock is back to under $24, getting a bounce from there up to about $30. And now you can see pulling back again, down 5% on the week. One that we thought was topping, and now I think is very bearish. By the way, in this group, GameStop down 4%. We think one more dip, and Macy's down about 3%, and it just hit resistance and turned over. BABA is the next one that I want to look at, and that you can see it gets right up into this fib extension zone right there and turns over. Now, I'm going to teach you a little bit about cyclic theory, and that is the cycle low essentially is right in this area, and you can see it tried to break under it. Now, just getting near that level says that this cycle has turned over. What that does is point to February as the low of this decline. BABA is a much worse pattern than the ones I've been showing you. It's got more time to fall. It fell from the right spot. It fell at the right time, and you can see the cyclic rhythms in here as you got the rally through here, and then the brief sell-off, and then the rally, and rolling over into this time period. BABA is looking like a very bad pattern in here, and we're going to call that one of the worst that we're looking at this week. U.S. Steel X has gotten had a real rally up to that fib extension zone right there, and then has started to roll over. The hope, of course, is that there's going to be some sort of tariffs on Chinese steel, and that's to me, it's not very likely, because President Trump needs China to go after North Korea. So you can see in here again, this points to the second week of January, to that intermediate support. We think it's going to pull back into there under 29, and that's probably a buying opportunity for another up move in there. But we don't see U.S. Steel as a stock that's going to go crazy on the upside anytime soon. We'll look for a pullback and another rally, but not overly bullish in that stock when we look at it. So that is the worst stocks of the week. Not a lot, really, as we get to the end of the year, and there doesn't seem to be all that much interest in pushing any of the stocks around all that far if they don't have some really significant news. That's it for the worst of the week. We'll be right back with our short-term view for the coming week. All right, short-term view for the coming week. Do this every single week and look at, well, the short-term view, which is the daily charts. So I always want to take an accountability of how we did in the last week. And we actually had a really good week. Now, those of you that only follow what we say in the stock market are probably saying, what is he saying? But we look at 5 major markets, and we actually had light crude, the currencies, and the gold market pretty spot on. A bond market, we were very close. The stock market, not. We looked like we were going to be pretty close when the market fell on Thursday, but then this giant recovery that we're seeing on Friday and this move to all-time highs has ended that. So we were wrong on the week. So now what I'm going to do is because we will not have a market week next week, I'm going to give you, pretty much a little bigger perspective on what I think is likely to happen in the next couple of weeks. So we're going to start with the light crude market, which we thought last week was going to be range bound, and pretty much still seeing it as range bound, though we think we're picking up a little bit of a negative bias in here when we look at this. So that would mean that the downside of the range may be a little more likely than it was before. Here is light crude on the daily chart. We'll take a closer look right in here. And we had thought that it was, going to hang out between that high 55s and high 57s. And pretty much that's what we got. You can see that right in the range that we expected. Now, we've got some corrective things that are going on in here. And this is starting to get heavy, and with natural gas really heavy, we think that this is going to start to form a little bit of a downward bias in there. So we're going to kind of lower our range for the next couple of weeks. This peak that you see right over here at about 58.60, between there and 59 is basically the high of the range that we think we're going to see. The downside of it now gets down to about 55 potentially right there that it could move down to. The formation we're basically looking for the next couple of weeks is right in here. You could see that with the 2 weeks from now being the greatest risk in this corrective period right there. So range bound with a slight negative bias is what we see in there. For the dollar market, which is pounds dollar sign DXY, you can see in here you had this big down day right there. That was on the Fed day when they were so dovish, but then the market recovered. So it was a pretty choppy week. There's a diamond forming in here that you can see right like this. Diamond formations are consolidations normally, so there could be a little more upside in here, a breakout in there. If it breaks down under here, you'll know it was a stalling area in the resistance zone. We don't think that there's much more past this resistance zone, however, and we think that it's going to be rollover. We call the next 2 weeks to the downside in here. We think that there's a good chance that this low over here around 92.50 is going to get tested. And you can see our projections over here pointing down that way. So we see the dollar as being weak. And we thought it would have a down week, and it's sitting right now. It was a down week, and it's now an unchanged week. The euro currency, which we thought would have an up week, which is, of course, inversely correlated to the dollar, has essentially had this tiny little up week. It was a lot better, and just as the dollar turned up, this turned back down. You can see we're in an upward trend. We're calling that these 2 cycles pushing up are going to lift it over these next couple of weeks. So we're looking for around 1975 here. In 1975 and the upside in the next couple of weeks in the euro currency. Now we'll switch over and we're going to look at the metals, /GC. We thought that they were going to rally. Our upside target was in gold was 1266 to 73. It got right up over here today to 1265, so it followed the pattern just as we expected. We thought it would be that up week. You can see that we think this resistance area is a problem by the way we have this projected. So we think it's going to try to keep getting up and fail. Upward is around 1271 to about 1278 is what we're looking at in here on the upside, but then we don't think it'll be able to hold and then roll over for more correction into the early part of next year. So we're just going to call a little higher prices in there and rolling over in the gold market. In the silver market, we see something very similar, and that is getting a rally up into this area. We thought it would rally, and your resistance zone right up here is 1635.36 up to this number right over here, about 1657. We think it'll try to get into there and roll over and fail. That makes for the next couple of weeks just minor changes really, as rally and then pulling back, which we have continued to think that the best prospects for the gold market were coming in next year, not this year. So that's a look at the gold market. The bond market, fortunately, has ZN. We thought we would get a small rally that failed in here, and that's basically what we got. So you can see in here, just look at this little big cycle. We call this a harmonic family right here with the three smaller pieces in it. And then we thought that it would pull back right into this time period. And then over here is another rally. So we think that a couple days down and then rally in here, this to us coincides with a holiday pop in bonds and a holiday drop in the stock market, though nobody could believe that that would possibly happen, right? That says kind of more choppy stuff in here. You could see that the 10-year is essentially in a little bit of a downtrend right there. It's a little bit of a downsloping pattern. 30-year, when you look at that right here, it's in an upsloping pattern. And there's your yield curve changing. You can see that we expect to see a little bit more on the downside in here, a little bit of a pullback, and then moving back to the upside, just like we do in the 10-year. Again, what we see is, some rallies that fail. The 10-year testing about 124.23. This one getting up to about 155.15, right up in this area here over these next couple of weeks. So we're looking for a pullback and then a rally over the next couple of weeks in the bond market. So we're mostly right on the bonds and pretty spot on in the other ones we looked at. That gives us about 75% on the week. That's a big improvement over the 15% that we had the previous week, our worst week of the year by far, in looking at the very short-term cycle patterns. Short-term cycle patterns to me are the hardest of all, and much more consistency as you saw in those weekly patterns throughout the show. I showed you a ton of them, S&P 500 and all of those stocks. So if you want those on your Thinkorswim platform, make sure you let me know and I'll send you that half-price special. All right, so let's take a look at the stock market. I thought that the stock market would fall and then recover. Unfortunately, I thought it would test 2637 and then have a small recovery. It didn't get down that low, and what it did was then had a giant recovery and then went to a new high. I get no credit for that whatsoever in the S&P 500. Let's take a look at this SPX pattern, which just keeps grinding to the upside. And it seems like every time I do these charts and send them to my members, comes the end of the week, then I need to revise them because they keep taking out the highs and all the numbers then change. Here you could see in here that it is made a new high, 2679. Our anticipation was that it would fall harder into this zone over here and then rally like this. That's what we were following, is these patterns right in here. And you can see that, well, that brought only a minor dip and then a much stronger rally. So again, we have a bearish bias and not following our momentum patterns, which you can see just plain out have been positive this whole way. That's the slim ribbon. It's been screaming positive. Well, seemingly forever. So that is a look at what's happened, and you can see that what we're looking for is for it to roll over. I showed you so many stocks that look like they're going to fall and bottom into this period right in here, the first week or two of the year. That's why we believe this is rolling over, and that sometime in these next 3 weeks there's going to be some solid downward action in there. And that's what we're going to call over these next 3 weeks down for that period, and what would probably be another very modest overall correction in the stock market that just is massively being bought. You asked the question, how is that happening? Well, the basically the attitudes for investors are that tax plan passes, there's more money in corporate coffers, their earnings go up, the valuations that look extreme now, then they're really not, if that is accurate. And then the companies have more money to buy more stock or to pay out bigger dividends. Well, they better buy more stock or pay out bigger dividends, because the valuations related to everything we look at, and book and price to sales is at an all-time extreme. Those valuations, the corporations better do something in order to hold the market up, or in 2018 it's going to look a lot different, and I think it is anyway. So you're going to want to watch my year-end show. A little quick peek at the NASDAQ in here, and you could see that it is, again, following the pattern of the Russell, and though the Russell's much weaker, the timing on the pattern is really what we're looking at in here, and that comes up in between these fib extensions again. Again, we're looking for it to roll over and have a correction into the first week of the year. So it lines up, all of these patterns are lining up pretty closely together, all of the indexes. So that's it. That is our short-term view for the next couple of weeks. I hope you have enjoyed the show, and I certainly hope that this has been a wonderful year for you, and if it's been a challenge, then everything is going to be better in the next year. Because we're all going to make it so. So a happy Hanukkah to all of my Jewish friends, and a Merry Christmas coming up, because next time I'll be back will be after Christmas from my vacation period. I want you to be unbelievably careful, because it is so crazy out there, and I'm always wishing you great trading.